Okay, Chapter 29, HR 10 KEO plans. True or false? A KEO plan is a qualified retirement plan that covers self-employed business owners and partners. That is true. That's the reason for the KEO plan being designed. Question 2. KEO plans are much simpler and less costly to administer than other forms of qualified plans. Again, that is true. Number 3. An individual who has a KEO plan cannot also invest in a traditional Roth IRA. That is false. Question 4. For a self-employed individual, earned income takes the place of compensation in applying the qualified plan rules. That is true. Question 5. A sole proprietor must not have employees to establish a KEO retirement plan. That is false. A sole proprietor, one individual, may have a KEO retirement plan. Multiple choice. Question 6. For the self-employed owner of an unincorporated business, advantages of a KEO plan over a traditional IRA include which of the following? A. Employees of the business may be excluded from participation in the plan. No, that is not true. B. Contribution limits for a KEO are higher than limits for a traditional IRA. That is true. C. Income generated by investments in a KEO are tax deferred until withdrawn from the plan. That is true. Therefore, A is not true, but B and C are true. Question 7. The earned income that a self-employed person uses to calculate a KEO plan deduction is, this is based on the formula to come up with earned income. The answer is D. Net business income, including the deduction for the KEO plan, less 1/2 self-employment tax. The answer is D. And the only way to know that answer is D is to understand the formula to calculate earned income. Question 8. The feature that sets a KEO plan apart from other plans is that A. It is established by self-employed individuals such as sole proprietorships and partnership. That is very true. B. It operates like a hybrid defined benefit plan. No, it is not a hybrid plan. C. It is not a hybrid plan like a defined contribution. It is either a defined benefit plan or a defined contribution plan for self-employed individuals such as sole proprietorships or partnerships. Question 9. A KEO plan is most commonly designed as A. Defined benefit plan. That's not true. It can be, but it's not most commonly. B. Defined contribution plan. That is true. That is what is most commonly designed as. The others are not most commonly designed. So the answer is B. Defined contribution plan. Question 10. A KEO plan is useful when A. A self-employed person needs to shelter current earnings from federal income tax. That is true. A corporation has a large younger workforce. That's not true. It's designed for small individuals. C. A corporation adopts a corporate plan. That is not true. It's for a self-employed person. And D. A self-employed person incorporates her business and becomes an employee of the business. No, that is not true. Question 11. A 50-year-old self-employed person, severely injured, no longer able to perform the tasks of any occupation. Which of the following is true? Well, this individual is permanently disabled, and answer E, Otis can withdraw any contributions and earnings without penalty. That is true in an HR 10 KEO plan. Permanent disability, you may withdraw any contributions and earnings without penalty. Number 12, Tandy is self-employed owner. She has a KEO plan, provides incidental insurance through a cash value life insurance contract. Her premium this year is $1,400, of which $800 is for pure life insurance. The rest increases cash value. Tandy, A, can deduct $1,400 as a Keogh plan contribution. No, you cannot deduct all of that. Can deduct $800 of the premium as a plan contribution. No, you cannot deduct the pure life insurance protection. Must report $1,400 as taxable income. That is not true. You do not report the whole premium as taxable income. D, can deduct $600 as a Keogh plan contribution. That is correct. Therefore, of the $1,400, $800 for pure life insurance protection cannot be deducted, but it is the cash value portion, $600, that may be deducted as a Keogh plan contribution. And E is not correct. You must not report $600 as taxable income. So the answer is D. So it's the difference between total premium, pure life insurance, that's the cash surrender value. You can deduct that as the Keogh plan contribution. In essence, the contribution is giving cash to the employee in the form of cash value. Therefore, that is the contribution. Question 13. Please pause the video. You can read the question. Basically, it's a university professor who is a self-employed person in addition to the university income. He's considering adopting a money purchase Keogh for self-employed business. As his advisor, you tell Winston, A, he cannot establish a Keogh plan because he has a qualified plan in the job where he earns the most. That is not correct. It makes no difference what other job you have. B, he can establish a Keogh plan and deduct up to 25% of his total earnings. No, self-employed individuals have to deal with self-employed earnings, not total earnings. C, he can establish a Keogh plan and deduct up to 25% of his gross self-employment earnings. That is not correct. It is not gross. It must be limited. D, he can establish a Keogh plan and deduct up to the statutory limit as counted by his total income. No, it is not total income. E, he can establish a Keogh plan and deduct up to 25% of earned income from self-employment. And that is true. And it's the definition of earned income from self-employment that makes this true. Question 14. J. Castile had a business. Unfortunately, a sudden storm damaged, destroyed half his inventory. He's now beginning to be pressured by some of his creditors. He's heard that his Keogh fund can be seized by his creditors if he cannot work out a repayment plan. You tell him that this is false. That is false. Creditors cannot attach your retirement Keogh fund.